Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin in the Asia Pacific. Australia has enacted one of the world's toughest crackdowns on youth access to digital platforms, barring all under 16s from holding accounts on major services, including Facebook, Instagram, TikTok, Snapchat, YouTube, X, and Reddit. The legislation passed in 2024 and coming into force from the 10th of December yesterday responds to mounting concerns over online bullying, grooming, sexual extortion, and youth suicide. The Prime Minister argued that children, quote, should be playing outside, discovering music and art, end quote, not trapped in algorithmic feeds designed for engagement rather than well-being. The ban, while widely supported, backed by 77% of Australians, according to some polling, has triggered fierce debate. Advocates say it's a long overdue shield against an industry whose algorithms outmatch children's cognitive defenses. Critics counter that it infringes on privacy, may drive teens toward riskier corners of the internet, and fails to address the root problem, the production of harmful content itself. Others have expressed concern that the move sets a precedent and erects a framework for state control over the use of the internet. But beyond the cultural and ethical questions lies a significant economic story. The law threatens to remove roughly 2.5 million under 16 Australian users from the monetization pipelines of Meta, Google, Snap, ByteDance, and others. Although Australia is a relatively small market, the demographic matters. Young teens are a highly prized cohort for advertisers because they shape long-term brand preferences and are early adopters of digital culture. Losing them, especially if other nations, like in Europe, follow, could dent future revenue projections and undermine growth narratives in markets where user saturation has already plateaued. Compliance costs will also rise. Platforms must now deploy multi-layered age verification systems incorporating document checks, biometrics, and behavioral analysis. These technologies are expensive to build, controversial to implement, and resource-intensive to maintain, especially at scale across global markets. The legislation allows for penalties of up to 50 million Australian dollars, approximately $33 million US, but the larger financial threat comes from the precedent it sets. Regulators are now explicitly empowered to demand algorithmic accountability and demographic transparency. From the perspective of these technology companies, the bigger strategic risk is contagion. New Zealand, Denmark, and other parts of Europe are already considering similar age restrictions. If the Australian experiment becomes a blueprint, technology giants could face a structural shift in how youth engagement and thus the future of platform growth is regulated. As Ursula von der Leyen noted, Europe is, quote, watching and learning, end quote, and Singapore has opened discussions with Canberra. Australia's ban may mark a cultural reset for youth online behavior. For big tech, it represents something far more consequential, a signal that the era of unfiltered access to the next generation of users and the advertising dollars that follow them may be coming to an end. Next up, we move to North America. The Federal Reserve delivered its third consecutive interest rate cut on yesterday, lowering the benchmark federal funds rate by 25 basis points to a range of 3.5 to 3.75%. The move, approved by a 9-3 vote, exposed widening divisions among policymakers and signaled growing uncertainty about the path ahead. Chair Jerome Powell said the latest cut should help, quote, stabilize the labor market, end quote, while keeping pressure on inflation, which remains above the Fed's 2% target. He emphasized that additional easing is not a foregone conclusion, though he noted that no officials view a rate hike as their base case. The central bank also maintained its projection for just one rate cut in 2026, signaling a more cautious long-term stance. Investors trimmed expectations for next year's easing from 3 to 2. Markets nonetheless reacted positively. The S&P 500 rose 0.7%, nearing record highs, while 10-year Treasury yields dipped to around 4.15%. Dissenting votes highlight the Fed's internal struggle over competing economic risks. Two pushed to hold rates steady, citing persistent inflation. The governor appointed by the US President Donald Trump argued instead for a larger half-point cut to counter labor market weakness. Unemployment has climbed to 4.4%, even as inflation remains elevated at 2.8%. The meeting also carried political undertones. The US President, Donald Trump, who has criticized the pace of rate cuts, said he would soon announce his pick to replace Powell when his term ends in May, a backdrop that has intensified scrutiny of the Fed's independence. To ensure liquidity in funding markets, officials authorized new purchases of short-term treasuries beginning the 12th of December, tomorrow, shifting away from the balance sheet runoff that has been in place since 2022. Amid delayed data from a government shutdown and conflicting economic signals, Wednesday's decision signals a Fed increasingly torn between battling inflation and supporting a cooling labour market, a balance that will define monetary policy in 2026 and beyond. Next up, we move to Europe. If you want to continue to be on top of updates like this through grounded and sober analysis, consider subscribing to Market Update, and if you're getting some value from today's episode, it's a huge help if you can just hit that like button. There is also a Buy Me a Coffee link in the description below for those who want to help keep the channel financially sustainable. I rely primarily on the audience support to keep going, so this is a big help as well. Thank you so much. And finally for today, across Europe, defence spending is surging at a pace unseen since the Cold War. A structural shift triggered by Russia's invasion of Ukraine, rising geopolitical uncertainty and fears of a more isolationist US under the US President Donald Trump. From Britain's sub-building revival to Germany's vast rearmament plans, policymakers hope this military build-up will do double duty, enhance security while reviving stagnating economies. The macroeconomic picture, however, is far more complex. The optimism is palpable in towns like Barrow, where BAE Systems is again cutting steel for nuclear-armed dreadnought submarines after decades of industrial decline. Germany, meanwhile, has committed 650 billion euros in defence spending between 2025 and 2029, more than twice its outlay for the previous 5 years. Local economies across German border regions are already feeling the ripple effects as missile maker Diehl Defence expands production and KNDS converts factories to maintain and build armoured vehicles. Yet defence spending carries an economic paradox. The sheer scale of proposed outlays, the UK alone plans an additional £36 billion per year for a decade, will mechanically lift GDP in the short term. But economists warn that without rapid expansion in Europe's depleted industrial base, the surge risks pushing up prices rather than output. Shells for Ukraine are an illustrative case. Billions have been spent, yet production capacity remains constrained and costs continue to rise. The macro challenge is not money, it is absorption. Europe's manufacturing sector, weakened by years of offshoring, demographic decline, and an ailing automotive industry, lacks the capacity to meet demand swiftly. Economists argue that underutilized industrial space in countries like Germany makes a defense-led stimulus feasible without crowding out private investment. But converting civilian factories into military production lines is slow, expensive, and often yields limited spillovers. Defense's fiscal multiplier, typically below 1, also tempers expectations. Each euro spent produces less than a euro in GDP, meaning defense is a poor tool for short-term stimulus compared with infrastructure, the energy transition, or education. The long-term economic payoff hinges on something else entirely: innovation. US history shows what defense-driven R&D can achieve, from nuclear energy to GPS. Europe invests a fraction of that, 0.04% of GDP in the EU and 0.12% in the UK versus 0.62% in the US. Economists argue that unless Europe channels far more funding towards smaller, high-tech firms developing dual-use technologies, the spending boom will serve mainly to enrich incumbent giants like BAE Systems and Rheinmetall rather than lift continental productivity. Governments are starting to react. The UK plans to boost SME, small and medium-sized enterprise defence procurement, by 50% by 2028. Germany is tying armoured vehicle contracts to local production, but structural constraints remain: skill shortages, slow-moving procurement processes, and supply chains still stretched thin. Europe's defence surge may indeed rejuvenate declining industrial regions and deliver strategic autonomy. Yet without deep reforms, faster contracting, robust R&D ecosystems, and a rebuilt manufacturing base, the continent risks missing its moment. As one economist put it, expectations of defense-led economic miracles may collide with industrial reality. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Thursday, and I hope to see you for the next and this week's final episode of Market Update tomorrow.